Good morning, everyone. In this session, important regulatory development in the area of international trade, that is, Foreign Exchange Management, Export and Import of Goods and Services Regulation 2026 shall be discussed. The Foreign Exchange Management, Export and Import of Goods and Services Regulation 2026 were issued by Reserve Bank of India and notified on 13th January 2026. Yet, this regulation will come into effect from 1st October 2026, and this replaces earlier Foreign Exchange Management, Export of Goods and Service Regulation 2015, which is mainly governed export transaction. I repeat, effective from 1st October 2026. Why so? Now, banks, exporters, importers, including software exporters, must modify internal systems, documentation, and compliance procedures. This transition period allows authorized dealer to update compliance system, exporter importers to understand the new procedures, updates to EDPMS and IDPMS monitoring system, that is export data processing and monitoring system or import data processing and monitoring system. This new framework is designed with a clear objective to modernize and simplify compliance in foreign trade transactions. So, essentially, the new regulation attempts to strike a balance between ease of doing business and regulatory oversight. Next, one of the most notable changes in 2026 regulation is the expansion of their scope. Under 2025 regulation, the focus was primarily on export of goods and services. However, the 2026 regulation moved towards much more integrated framework covering export, imports, as well as merchant trade transactions. What is this merchant trade transactions? A merchant trade transaction is a transaction in which an Indian entity, that is merchant trader, purchases goods from a supplier outside India, and the same goods are sold to a buyer located in another foreign country, and the goods never physically enter India. Earlier, merchant trade was governed mostly through RBI circulars and separate instructions, which sometimes created interpretational challenges. Similarly, import compliance guidance, which were earlier spread across multiple instructions, now been codified within the regulation themselves. Next, another important change introduced by 2026 regulation relates to time allowed for realization of export process. Under the 2015 framework, exporters were generally required to realize the export process within 9 months, either from the date of shipment of goods or from the date of invoice for services. Under the 2026 regulation, the period has been extended to 15 months. With respect to import, no change. An importer in India must complete the payment for import of goods within 6 months from the date of shipment. Additionally, where exports are invoiced in Indian rupees, again, invoiced in Indian rupees, the realization period has been extended further to 18 months. Exports invoiced in Indian rupees. Let us understand this. It means the export invoice issued by the Indian exporter is denominated in INR instead of USD, Euro, etc. The overseas buyer pays in INR through the net banking system, like an Indian exporter sells machinery to a buyer in Nepal and issues an invoice for 50 lakh instead of USD. When INR invoicing is permitted, trade with Nepal and Bhutan, trade settlement mechanism, that is rupee trade settlement mechanism, has been introduced by the Reserve Bank of India, which states that the trade between India and other country can be invoiced in INR. Settlement happens through special rupee pass-through accounts maintained by foreign banks in India. That is, a foreign bank account maintained with an Indian bank in Indian rupees for settling international trade, as permitted by RBI. Pass-through account is nothing but our account with you. Next, bilateral agreements between countries or RBI specific approval. Next, for warehouse exporters, the regulation now specify 15-month realization period from the date of sale. Goods are exported from India and stored in warehouse abroad and sold to foreign buyers later from that warehouse. Overall, the change is expected to provide greater flexibility, ease working capital pressures, and support smoother and international trade operations. Next, we will move on to what is the realization given to small value transaction category. The thing is that the simplified procedure for small value transaction has been given. One, we will see the first scenario, closure of export entries. Export entries is nothing but export transaction. Earlier, the closure of export entries in the export data processing and monitoring system, that is EDPMS, required exporters to submit documentary proof of realization, which had to be verified by the authorized dealer. Now, 2026 regulation allows a closure of export entries up to 10 lakhs. Repeat, 10 lakhs based on the declaration from the exporter, enabling quick reconciliation and closure of minor outstanding entries. Next, an export entry is a record of export transactions created in the export data processing and monitoring system by authorized bankers. What is the purpose? The purpose is to track whether the exporter has received the export process under the Foreign Exchange Management Act 1999. Previously, closure of import entries in import data processing and monitoring system require submission and verification of documents such as invoices and payment record by AD banks. Under 2026 regulation, import entries or transaction up to 10 lakh can be closed based on declaration from the exporter, reducing the documentation burden and facilitating faster reconciliation. Next, the third category is reduction in export value. Instead of receipt, there could be a reduction in export value for some reason or other. Under 2015 regulation, exporter has to obtain approval from AD banker and submit detailed justification and documents for any reduction in export realization. 2026 regulation now permit a simplified declaration mechanism for a reduction up to 10 lakhs, allowing the exporters to declare the reduced realization amount without extensive documentation, while banks continue to maintain oversight. Overall impact is that the new framework simplifies compliance for low value export and import transaction, reduces procedural delays, and enables faster closure of monitoring entries while retaining regulatory oversight. Now, over to Sanjay, our team member, for the next part.
Let us now look at the declaration requirements for exports, where the new regulation introduced important and welcome simplifications. Earlier, under the 2015 regulations, exporters had to follow different regulations and declaration systems depending on the nature of exports. EDF forms were required for export of goods, while Softex forms are required for export of softwares. This often resulted in multiple filings, procedural complexity, and additional compliance burden, particularly for IT companies and service exports dealing with numerous transactions. Under the 2026 regulations, this process has been significantly streamlined by introducing a single unified EDF framework applicable to both goods as well as services in the exports. This move has helped in standardizing export documentation, reducing confusion, and making the process more efficient. For service exporters, the declaration must now be submitted within 30 days from the end of the month in which the invoice is raised, thereby providing a clear, structured, and uniformed timeline for compliance. Another notable simplification is that a single EDF is now cover multiple export transactions within a month instead of requiring separate documentation filing for each individual transactions. This greatly reduces repetitive filings and administrative efforts for exporters. Overall, the changes aim to streamline export procedures, reduce compliance burden, and enhance ease of doing business, especially for service exporters, IT companies, and business engaged in digital and technology driven exports. Next, the new regulations also introduce clearer and more structured provisions relating to merchant trading and import payments. In case of merchant trading transactions, the settlement period have been reduced from 9 months to 6 months. This changes is intended to promote faster settlement for trade transactions and strengthen financial discipline in cross-border trade. Another important development is that authorized dealer banks are now given explicit discretion to permit third-party payments. Earlier, such payments were allowed only in limited or selective situations, which sometimes created practical and operational challenges for businesses involved in international trade. Further, the regulations now make it mandatory to monitor export and import transactions through EDPMS and IDPMS systems. This significantly enhances regulatory oversight, improve transparency, and ensures better tracking of foreign exchange transactions. With respect to import compliance, advance payments for import continues to be permitted subject to approval from authorized dealer bank. However, if the import does not materialize, the advance payment must be repatriated back to India. Additionally, where business frequently make advance import payments, the bank may require security as a standby letter of credit or bank guarantee to safeguard the transactions. Overall, these provisions aim to strike a balanced approach, providing operational flexibility for business while ensuring adequate financial safeguard and regulatory control. Another important feature of 2026 regulation is the strengthening of compliance and governance mechanism. Authorized dealer banks are now required to maintain clear internal policies and standardized operating procedures for monitoring foreign exchange transactions. This ensures greater accountability, consistency, and effective implementation of regulations. These regulations clearly define the responsibilities of bank in monitoring export and import transactions through the EDPMS and IDPMS systems, which improves tracking and regulatory supervision. Another significant provision for exporters with unrealized export proceeds beyond the permitted time period may face restriction on undertaking further export transactions. This encourages exporters to ensure timely realization of export proceeds. In addition, the regulation formally recognize and codify the framework of INR trade settlement, supporting India's border strategy of promoting the Indian rupee in international trade. Overall, these measures aim to enhance transparency, strengthen accountability, and improve regulatory oversight in foreign exchange transactions. Follow us for more updates. Thank you.